Hello everyone, welcome to Learn Next. So today we'll discuss the part 4 of banking GK of our series. And let's start with the first question. What is the meaning of KYC in banking or financial sector? Correct answer is know your customer. So KYC means know your customer and sometimes know your client. So KYC check is the mandatory process of identifying and verifying the identity of the client when opening an account and periodically over time. So in other words, banks must make sure that their clients are genuinely who they claim to be. Next, where is the headquarter of Fitch Ratings? Correct answer is New York. So Fitch Ratings is an American credit rating agency and is one of the big 3 credit rating agencies, the other two being Moody's and Standard & Poor's. It is designated by the US Security and Exchange Commission in 1975. So Fitch Ratings is dual headquartered in New York and London. Next, Kisan credit card scheme was formulated in which year? Correct answer is 1998. So the Kisan credit card scheme is a credit scheme introduced in August 1998 by Indian banks. This model scheme was prepared by the National Bank for Agriculture and Rural Development on the recommendation of R.B. Gupta Committee to provide term loans for agricultural needs. Next, which organizations works solely to monitor and arrange flow of agriculture credit in India? Correct answer is Nabard. So National Bank for Agriculture and Rural Development Nabard was set up on 12 July 1982 on the recommendation of B. Sibaraman Committee with regards to the implementation of the National Bank for Agriculture and Rural Development Act 1981, and it has been the top development financial institution in India which has been majorly involved in the planning of policies and operations in the field of agriculture and other economic services in the rural parts of India. Next, on which rate the Reserve Bank is ready to buy or rediscount bills of exchange or other commercial papers? Correct answer is bank rate. So under section 49 of the Reserve Bank of India Act 1934, the bank rate has been defined as the standard rate at which the Reserve Bank is prepared to buy or rediscount bills of exchange or other commercial paper eligible for purchase under this act. Next, what is the minimum amount of transfer required for RTGS? Correct answer is rupees 2 lakh. So the real-time gross settlement RTGS system is basically meant for large value transactions. So the minimum amount to be transferred through RTGS is rupees 2 lakh. However, there is no upper limit on RTGS transactions. Next, who is the sole authority to issue and manage currency in India? Correct answer is Reserve Bank of India. So the Reserve Bank of India is India's central bank, also known as the Bankers Bank. So the RBI controls monetary and other banking policies of the Indian government. The RBI was established on April 1st, 1935 in accordance with the Reserve Bank of India Act 1934. RBI headquarter is at Mumbai. Next, the Banking Ombudsman scheme was introduced under which acts? Correct answer is Banking Regulation Act 1949. So the Banking Ombudsman scheme was introduced under Section 35A of the Banking Regulation Act 1949 by RBI with effect from 1995. So Banking Ombudsman is a senior official appointed by RBI. He handles and redresses customer complaints against deficiency in certain banking services. Next, SARFAESI Act 2002 related to which area? Correct answer is recovery of bad loans. So the securitization and reconstruction of financial assets and enforcement of Securities Interest Act 2002, also known as the SARFAESI Act, is an Indian law. It allows banks and other financial institutions to auction residential or commercial properties or defaulter to recover loans. Next, difference between all receipts and expenditure of the Government of India, both capital and revenue, is called what? Correct answer is budgetary deficit. So budgetary deficit is the difference between all receipts and expenses in both revenue and capital account of the government. It occurs when an individual, business or government budgets more spending than there is revenue available to pay for the spendings over a specific period of time. So this is all for this video, and these were some important banking GK of our series, and this was the part 4. Please like, share and subscribe our channel Learn Next to get regular updates. Thank you.